Hello everyone and welcome to Mutual Fund Review, where we review mutual funds in India. In today's episode, we will take a look at HDFC ELSS Tax Saver Fund, which is an ELSS fund that helps you save taxes. Every taxpayer gets a smile on their face whenever they hear the word tax saving. And why not? It's your right to save taxes, and the Indian government has offered this technique to save tax for a reason. So let's dive deep into the review of HDFC ELSS Tax Saver Fund and see how good is the fund and who should be investing in the scheme. Before reviewing the fund, we need to understand the category of this fund, that is ELSS. So what are ELSS fund? ELSS or Equity Linked Savings Scheme is the only type of mutual fund that lets you save on taxes under Section 80C of Income Tax Act 1961. By investing in ELSS funds, you can get a tax deduction of up to rupees 1.5 lakh. Suppose your income is 10 lakhs per annum and you invest rupees 1.5 lakh in any of the ELSS mutual fund per year, your tax liability will be calculated on rupees 8.5 lakh. This means that you can save up to rupees 46,800 per year on your taxes. It's a way to invest your money and enjoy the benefit of tax savings at the same time. Apart from ELSS, there are many other instruments in Section 80C, but out of all of them, ELSS has the shortest lock-in period. Money invested in ELSS will be locked in for 3 years, which means you cannot withdraw it for 3 years from the date of investments. It is the only category of equity mutual fund that has a lock-in period and helps you save taxes. These funds invest all the money into equities or the stock market, hence the market risk is involved in it. Now that you're clear with the ELSS fund, let's move to the review of HDFC Tax Saver Fund. First of all, the most important thing, the investment amount in this fund will be reduced directly from your taxable income if you mention this investments while filing your ITR. HDFC ELSS Tax Saver Fund was launched on 1st January 2013 and has consistently outperformed its benchmark and category average. We will review this fund in 5 parts: basic details, past performance, risk analysis, portfolio structure, and investment strategy. So let's start with basic details. HDFC Tax Saver Fund is one of the many great performers launched by HDFC Mutual Fund, which is currently the 3rd largest asset management company in India. HDFC Tax Saver Fund has assets under management of rupees 12,197 crore as of December 2023. Which is quite decent, as there are ELSS funds with as high as 33,000 crore AUM. However, you must know that the size of the fund does not tell anything about how good the fund is. The expense ratio of the fund is 1.15%, which is slightly higher than the category average of 0.96%. So you can say that the fund is slightly expensive compared to the average in the category. The minimum investment amount is rupees 500 for lump sum as well as SIP. But remember, every SIP installment is only withdrawable after completing 3 years of lock-in period. Now let's talk about the performance of HDFC Tax Saver Fund. So when it comes to returns generated by the schemes, it was not very good for a few years after the inception of the scheme. But later on, it picked up the pace, and in recent years, the returns have been very attractive. The fund has delivered more than 30% returns in 2023, where the category average was 27.88%, thanks to the bullish equity market of 2023. The 3-year return on HDFC Tax Saver Fund is 27.91%, and the 5-year return is 17.25%, which is slightly below the category average. So we can conclude that the returns of this fund are getting better, and this can be a good bet for suitable investors who are planning to do tax saving investments. Now let's come to how risky the fund is. Since nearly 100% of the corpus is invested in equities, it has a market risk. However, the fund manager has allocated nearly 90% of the funds in large cap stocks, so the risk when compared to other schemes in this category is low. This is because large cap stocks are known to have lesser market risk compared to mid and small cap stocks. This is also visible in the risk measuring ratios like standard deviation, beta, Sharpe, and other ratios. All the risk measuring ratios are better compared to the category average, which proves that this fund has lesser risk compared to majority of the ELSS funds in India. Hence, this can be a good choice for ELSS investors who wish to invest in a low risk tax saving scheme. When it comes to investment style, the fund manager Roshi Jain follows a defensive strategy in this high-risk category by focusing on growth-oriented stocks. 90% of the fund's investments are in large-cap stocks. When compared with the category average, the fund manager has much higher allocation in the healthcare and energy sectors, which are considered as defensive sectors due to their consistent demand regardless of the market condition. HDFC Bank, ICICI Bank and HAL have the highest allocation up to 25% of the fund's AUM. A total of 36 stocks are present in the portfolio from 10 different sectors. So that was all with the details of the fund. Now comes the most important part. Who should invest in HDFC ELSS Tax Saver Fund? So if you are looking to save your taxes through mutual fund investments and do not want to take very high risk, this can be a very good fund for you. As I explained, the ELSS is a very high risk category, but this fund has lesser risk compared to majority of the schemes in this category. However, it must be noted that this may not be ideal for all types of investors. It is always recommended to consult your financial advisor before choosing any fund. Subscribe our channel to stay updated with the latest content. We'll be back with reviews of more mutual funds in upcoming episodes. Also, do let us know which fund you want us to review next in the comment section. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.